You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means it's time once again for TWIFO, the final program here on our broadcast week on the old network. Also a fun, funky look back at the week that was, and in some cases still is, over there on the futures options side of the fence. So we're talking maybe your indices, maybe your energy, maybe your metals, maybe your ags, maybe all of the above. Maybe we'll sneak in some fluid milk, some hogs. You never know. It's going to sneak it into the old program here. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. I want to remind you guys, if you want to play along with the home game, two ways to do that. First off, if you're listening live or you want to listen live, grab the Mixlr link, usually by our social media, or you can follow us on Mixlr. Just search for Options Insider there. Set it and forget it. Once you found us once, you're good to go. Every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern. It's also a second layer. This show is the only one that has the second layer that you guys can also dig a little deeper, which you can head on over cmegroup.com/TWIFO, TWIFO. When you're there, guess what? You can click around all the cool reports that Nick and I are always using throughout the show. And because he's so nice, him and his team over there, Nick and his team, enable those reports to go a little bit deeper. So some of the extra links are live and all the other things that usually aren't live. When the show's live, those links are live too. So you can click deeper, see exactly what I'm talking about the activity on a strike, when things were opened and closed, etc., and so on and so forth. It's pretty cool and a nice little carrot for all of you who join us live every Friday at 1:30 p.m. Central. Of course, however you listen live after the fact via our app, via the website, we don't care. Just make sure you hit us up. Questions, comments, insights, pearls of wisdom. We do, on occasion, like to hear from you guys. Speaking of hearing from people, let's see if we can hear from my cohort, my partner in crime, Mr. Nick Howard, the founder of Bantix Technologies and the creator of a little platform I like to use around here called Quick Strike. Mr. Nick, welcome back to TWIFO, sir. It's that time of week.
Yes, it is. Oh, got to turn down my music. I was still in work mode. That time of week, yeah, nice. And you know what's even nicer? I turned off the lights in my office, and the sun is coming in through the window. Finally, the change in the location of the sun means spring is in the air, and I'm excited about that. So
you have all these fun recording spots where you join us from bed, from parking lots in Long Island, now from a nice sunset or sun streaming area of your office. All these nice little locations you come from, sir.
Yeah, we try to keep it interesting, moving around a bit, kind of making sure nobody knows where I'm at any given time.
Undisclosed location. Well, spoiler alert, I'm in the exact same spot every week, so I don't get to have any of your location-oriented fun here on the old TWIFO, sir. I don't know, Mr. Nick, I was thinking, maybe you're thinking the same way I am. I was thinking, since it's been such a hot and heavy area of the space, should we kick things off in the indices again, sir? Or you feel like going elsewhere for the beginning of our TWIFO journey?
No, I actually just tweeted an indices chart, and I think that's a good idea. And you mentioned that the links are live. The links are live, and funny enough, they've been live since last week because I forgot to turn them off.
Nick forgot to turn them off, so you guys had a bonus week, guys. Yeah. So take advantage of that one. That's a fun little bonus. That's just between me and you, Nick. No one heard.
Yeah, no. Hopefully people took advantage. I have to look at the stats to see how many clicks we got out there, but hopefully people are taking advantage of the fact that those things are open and they get to see some of the detailed information that's available on each of those clicks. But yeah, let's dive in. You can start with the activity. We can start with the volatility, whatever you want to do.
Let's get into our old friend, the eMini S&P. It's been a while, about a week since we checked in on it last here on the old program. You guys know, listeners, it's been a tumultuous week out there in index land. Been a tumultuous couple of weeks, quite frankly. Massive sell-off, extreme explosions in volatility. Then we saw some of that starting to reverse. We saw the indices starting to rally. Saw the vol starting to come in. And that seems to be the narrative coming into the final part of the week, even though as I'm coming into the show now, we're starting to sell off now on more political rumors and gossip out there. So the macro trend is still dragging us south. Net on the week, since the last time we got together here on the old show, we're actually still off about 5% here, which is interesting net given all the turbulence we've seen out there across the board. It's been kind of interesting as we're looking here. By the way, listeners, I mentioned you guys can find what we're doing here at cmegroup.com/TWIFO, TWIFO. And as I'm pulling it up myself, I'm getting some delayed quotes. So let me just fix this right here really quickly. Make sure you change those settings at the top there, listeners, so you too can play along with the home game. There we go. All right. And looking here, Nick, it's been, as we know, vol was an interesting story. Last week, exploding, just madness, I think is pretty much the only way to describe it. And then obviously a little bit less here coming in this week, maybe even before I get to, breaking in some of the hot strikes and things like that. Maybe we'll get your thoughts on kind of what we've noticed, because I've talked a lot. I just got off a whole show talking about all things index volatility. I'd be curious to hear your thoughts. It has been an interesting week. We are seeing some of that reversion people were maybe hoping for or perhaps worried about, depending on which side of the fence you were on, as the vol coming in a little bit. Are things kind of playing out the way you expected, Nick, or do you think maybe this is a little bit faster or slower than you expected? What's your take?
Well, the one thing I noticed in the middle of the week was just how much the skew changed from last week, and I tweeted that out. So the puts the puts obviously were very bid when we had our initial reaction to the move, but I think that was the most surprising is the volatility on the puts came in quite a bit this week, and the calls got a little bit better bid this week. So if you look at the quick skew numbers, you're going to see that. And I'm going to focus on the March contract because that's happened to be where I was looking, and that is the front quarterly. So so that was probably the biggest thing. Vol from last Friday to actually from last Friday, our high, we're in quite a bit from, we're almost at 25%. Now we're under 15% with the at the money volatility in the March contract. So I don't know. Am I surprised? I don't know if I'm surprised because I think that, one of the things that I benefited from doing the show myself personally is having to pay attention more than since we are primary development company. Prior to doing the show, I probably just mostly focus on building the product and not so much on the markets. But since we've been doing the show, it's really forced me to have to pay attention to the markets and just watching the reactions to the moves, right? And then having to be able to discuss those. And it just appears that the absorption of the bad news is just much more rapid than I can recall when I was on the floor, right? So if there was, although that's partially true, because if there was ever a big scare in the Eurodollars, you'd get a big jack up in volatility and it would hang around for a while. But then once the fear had sort of subsided, or there was no more fear of any more bad news or potential problems, then the vol would get sucked out of it like nobody's business. So I think we saw that here. I think and even with all the bad news with the reverse VIX and the VIX and the big losers, I think people kind of weathered the storm of this. They might have gotten beaten up on some of the short volatility plays they had on the downside, but maybe they had enough of a cushion from a profit standpoint that they're right back in the game here, because they hammered it pretty good. Vol's in almost 10 vol over the last 8 days, and 8 trading days. I'm looking at the 7th. We had a peak of like almost 24 vol, and now we're down to like 14 and a third vol. So I think I'm a little bit surprised that the puts got offered so quickly and the calls kind of reverted back. And if you go look at the quick skew, I can tweet this out. We saw in the March contract, the puts came in from being 25 to 30% rich to the at the money. They're down to like 21%, and the calls were 20% cheap to the at the money, and they're down to 10% cheap. So that's a big shift. And people got scared, they reacted, but they went back to their old ways. So I think until there's just like a much greater continued slide, right? We even when it was bad last week, we would get a recovery, then we get a slide back down, a recovery. So we haven't slid through any like really big supports, at least from what I've seen. So until we get that continued move down or just some sort of debacle, maybe we're not going to see, maybe this is what it is. People react and then they go back to sort of business as usual. So that's kind of the biggest thing that I noticed this week. And if you get a chance and you're looking at the reports, click on the quick skew numbers and you'll see what I'm saying, how the channel between the call and the put rich and cheapness has narrowed.
Why don't I let you run through some of the hot strikes this week? Because for some reason, all of a sudden, I'm having some problems pulling up this TWIO report. I'm going to have to switch browsers and see if I can get it up. So why don't I let you run through that a little bit, what you're seeing in the eMini while I get this up, sir. Go for it. I'll give you the big share this week.
Okay, no problem at all. So I'm going to focus. Let's focus with the March contract, which is where I started the conversation. A lot of the activity, it looks like, was taking place around the money here. So we had some big, the big numbers here are almost 34,000 in the 2,500 puts. So that's our big number in the March contract. And then actually, what do we got? It looked like I got a different number here, 25 puts. Oh yeah, so my numbers look a little bit different. Let me refresh that, because what they come up with. So we got 35 to 40,000 in the 2,500 puts in the March contract. So again, can't tell right now whether those are opening or closing. And Mark, you are right. I think you might be.
Is it showing delayed data for you too from last week?
No, I don't think. Oh, strikes by volume for the week starting March February 12th. No, I still got it.
Okay,
It
you're
looks
good
fine.
then.
No,
So I was showing me delayed stuff. Okay, you keep going. I'm going to figure
No, it's
mine
the
out here.
12th. No, sorry about that. No, so I'm sorry. I'm reading my report the wrong way. So, um, yeah, we have around 40,000 contracts total in the 2,500 puts, and right behind that, another 40,000 in the 2,600, another 30,000 in the 2,400. So a lot of downside, not a tremendous amount of opening in any of those strikes. So a lot of trade around those strikes. So we probably have some activity, just people getting out of positions or trading around positions, or people that had those, that maybe people late to the game trying to get some downside are coming in, and people who are fortunate enough to have that, they're getting out of some of those. Or people doing what we talked about, saying, hey, this is cheaper than I expected it to be, so I'm going to get in while I can. And the other people going, well, it's getting cheap, so I'm going to get out of it. So there's trade there. So there's not a lot of change in open interest, and you can see that across all the downsides. We got a lot of good activity in the downside, but not a lot of change in OI. And pretty much the same thing here on the call side for the March contract. Some pretty good activity on the upside, but really sort of a flattish from an OI standpoint, with just maybe with an odd strike, the 2790 strike, with having the greatest change in open interest. So that's on the March contract. If we go look, we have weekly expiring today, and then we have a weekly, then we have one 4 days from now, which is a Monday. Then we got that would be a Tuesday, and then we got a Wednesday weekly. So pretty good activity there. Not a tremendous, not a tremendous amount. So we're seeing most of the activity this week took place in that contract, in that EW3G8, the contract expiring today. So a lot of trade around the 2600 strike, so 35,000 or so in that put, and definitely quite a bit in the 2750 strike and the 2725 strike. So you see a lot of trade around the money there in the front, and it's good. Obviously, it's good. People still a lot of sentiment on both sides of the market. With that short-dated contract getting quite a bit of the volume. But March was the leader with about 1 million contracts, and then that weekly expiring today had about 900,000. So really, like we talk about all the time, the fact that we see those weeklies so active in these, and again, eventually, once it becomes more common, we're going to see that same kind of activity in the other products as well. But really, the big takeaway from and again, it's really sort of, to me, the Eurodollars, the eMinis, there's so many strikes that trade, so much volume. It's really just a matter of, you pick which ones you want to talk about, but there's so much activity across all the board and so many expirations. For me, the bigger issue and the biggest issue, and probably the most telling thing, is just just across the board how and once you start to go out past 60 days, you don't see you don't see the puts get beat up and the calls get offered as much, or calls get bid as much as you do early on. But on the short dated stuff, inside of 30 days, you're seeing the puts definitely got some wind taken out of the sails, and the calls definitely got a little bit of life added to them. So I think that should be something we should just pay attention to as we go forward. If the market starts to, kind of trade sideways here and doesn't do much going up, we see if those calls get hit a little bit, and see if those puts continue to get off, or see if the skew changes at all this week.
Yeah, it has been a fascinating one to watch as I'm wrestling here to get my my stuff up in front of me. But it has been an interesting week here through February 12th. That would be actually today, which is fascinating. To see. Got to have the right settlements and the right dates, Nick. Otherwise, things are a little bit harder to read here. And you're right; it has been fascinating to watch. It is kind of fun, getting indices back here on the old TWIFO show. I know we don't get a chance to do it often because we talk about them on a lot of our other programs as well. So it hasn't needed to pop up here as much, but still fun to get going on there. In terms of weird, odd strikes, we got a few of those floating around out there as well. All the way out there in DC this year, we see someone loading or trading about 12,500 of the 31 half calls. So if these levels here aren't bullish enough for you, you're feeling a lot more upside by the end of the year. Maybe your 31 halves are where you want to be. Or if you're the flip side out here and you want to play maybe middle of the year like June, you can join our friend here who traded shall we say, quite a few, almost 50,000, 49,900, 191 to be precise, of the 1475 puts. Again, those are in June. Pretty much all of that opening. So someone opening for size on the 1475 put strike out there. That is just, I think, crazy town. That might, I don't know, Nick, we'll have to see for some of our other complexes. But I think that might be my crazy trade of the week. It all opened on Monday, which is an interesting time to be opening the 1475 puts. But still, I'm trying to think of some other trades that line up even close to that strike level. We got 31 halves, 2850, 1475. Mr. Nick, what are your thoughts there on just size opening on the 1475 strike in June this week?
Yeah, I mean, that's like a debacle strike, right? I mean, that's basically almost having the indice from where it is now. So that is pretty, and there's not a lot of blocks that happen in the indexes. So that's probably an outright trade, and that's gotta be some VAR cover, right? It can't be a spec. That's gotta be somebody covering like a third standard deviation move, or outside of 3 standard deviations. And I could probably take a look at that and see what I think where that thing comes into play. But yeah, that one to me, that definitely could be. I'm going to look at the June contract here real quick. That's way, way, way out there. So the third standard deviation in the June contract, the tail end of the third standard deviation on the downside is the 2100 strike. So you're talking about, and that's the 3 standard deviations is a total of like 600 points on that. So you're talking about almost another 3 standard deviation move if you look at it just sort of easy math in terms of trying to get to that point on the strike range. So that, we talk about this a lot. If you're trying to cover yourself, you got to figure that are better strikes to cover, right? So when you see those nutso prints, it's got to be something where somebody says, hey, you got to cover out this far on your risk, and that's the end of it, right? I mean, is there any other reason for that? What do you guys talk about when on the shows that really focus on the indexes? Some
algo went rogue on the 1475 strike. Yeah, you're right. That has a little bit of the feel of some risk manager. Maybe he doesn't understand the option space very well, saying for some reason you have absurd tail risk and you need to get it off way down. I don't know why that strike. You're right. That there are so many other strikes, so many other ways you could think of doing. Maybe you want to if you want to get something down to there, maybe you do a vertical. Something just anything to not trade there. If you're opening selling on that strike, either way, that would also be just a bizarre. Granted, maybe they're taking advantage of a little bit of the dip in the S&P to get something off at levels down there they probably otherwise couldn't. Still, it does remind me a little bit of the guys I used to see out in the SPX who would just live around all those teenies. They were teenies back then, all the teeny puts, and just live to blast them away or trade those things. And this one has a little bit of that same wrinkle, that same flavor to it. Speaking of flavors, net on, we talked at the beginning of the year, obviously, about looking back on all things 2017. The folks over at Tab, who do a lot of research on the space, finally came out with their futures options review for 2017. And they're kind of in line with what we were saying from the beginning of the year, that futures last year, 2017, decent year for futures. Net up 2% across the board. They're kind of looking at across the full space of suites and offerings. Overall, futures options, though, is where the action was, up 10% over the levels they saw in 2016. They predict new records going to be set in 2018. I don't think that's going too far out on a limb to suggest that. Also interesting of note, the number of FCMs actually ended the year down, with, of course, futures commission merchants down at 63. A lot of consolidation going on in that side of the space. But they're thinking maybe better interest rates may lead to more FCMs lurking on the future. We all know FCMs and brokers in general tend to make a lot of their money on margin. So when rates are more favorable, it tends to be a more favorable environment for them. So we shall see. But I thought it was interesting, Nick, that we're getting a little bit of confirmation of what we've been talking about earlier here in the show. That 2017, pretty decent overall year for all things futures options. Speaking of interesting time periods, it's been a good time to be back in the bullish driver's seat in crude. We know a lot of you like to spec on this one. We've been talking for a while about how the rent. Can you pay the rent in crude? The answer for a long time has been yes, and continue to deliver again this week, just in net gamma scalping ability of nothing else. Those deltas are paying off for you here. Crude closing right around 61.5 this week. Of course, we're talking WTI up about 4.5%. So a good week for crude. We kind of were wondering last week. It was, of course, last week we saw the down move. We saw the spike in vol. People were wondering, as they have all the time, whenever vol spikes in crude, the first question we get from listeners is this going to last, or is this kind of a brief blip? And the thing we always say is, well, it's got to sustain this, right? It's got to stay down there, maybe continue moving down, or something along those lines. If it just settles, or if it starts to move up again, you're going to see the vol come in. That's kind of exactly what we saw. It started moving back up. The vol came in pretty aggressively, shall we say, across the board here in WTI, point and a half, depending on where you're looking out there in the term structure. So yeah. Unfortunately, thankfully, the underlying movement, if you were long some premium, could have made up for that. But yeah, vol coming in apocalyptically. So if you did put it on last week, which hopefully you didn't, hopefully you were trading before then and you've been trading around ever since. If you put it on those levels last week, you might be wearing it a little bit this week. And in terms of what was lighting it up out here in our old friend WTI, if you said nearer term bulls like April bulls and fairly out of the money, but not crazy out of the money, not like 75s, talking more measured 65 strike range, then you would be correct. It was the April 65 calls leading the charge here on the upside with a lot of paper throughout the week. Total of about nearly 29,000 contracts going up. The lion's share about 11,000 going up on Wednesday, 6,500 on Monday, and the rest kind of scattered throughout the week. A little more than half of that total, or a little less than half, I should say, total opening, almost 11,000 contracts opening net on the week. So a lot of opening paper on the 65s. We talked last week how some people on the upside seemed like they were giving up the ghost. They were shutting down positions north of 60. This week seemed to be opening again. So tale of two different weeks out here in crude land. Then we fall off a little bit for our number 2 trade with a bullet. It's kind of a tie between the double puts, the 55 puts, and the 60 calls. Again, maybe showing a little bit of diversity of opinion out there in crude land this week. Both of them doing a little bit north of 15,500 contracts. Let's go double puts first because they're slightly more. They're closing in on 16,000. They did the lion's share on Tuesday, actually, about 6,000 going up on Tuesday. The rest kind of scattered throughout the week. That's kind of a lot of back and forth paper again, with only slightly net opening, about 500 contracts on the week. And hot on its heels were the 60 calls. Again, all of this out here in the April contract, which did about 50, almost 51% of the overall volume this week came in the April contract. And the April 60s doing about 15,500 contracts. The lion's share coming on Monday, 4,600 going up, then about 3,600 net opening on the week. So a decent percentage of opening on this, effectively actually now in the money strike here on these calls. So people perhaps opening throughout the week as crude was rallying and maybe establishing again, with a lot of that happening on Monday. That's probably the way it played out throughout the week. Then let's skip on out of April really quickly, see what else we have lurking. June also was active on the tape, with also kind of tied for number 3. The June double puts are also pretty active, about 15,500 lighting it up there as well. The lion's share, about a third coming on Tuesday, 5,000 going up on Tuesday, 4,000 on Monday, the rest scattered throughout the week. Net slightly closing, about 600 or so closing on the week. So a lot of back and forth on that double 55 strike out there in June as well. So that's apparently the 65 and 55 where a lot of the action was this week out here in WTI. Yet again, not a week to see the weeklies really rise and shine. We talked about that ad nauseum on the show. We won't debate it at length again. It does seem to be something structural, not with the product itself, but more with the way it's laid out, maybe at some of the FCMs and brokers, or maybe bury those contracts a little bit, because clearly people like near-term exposure, just not in those contracts for whatever reason it may be. And just digging around here really quickly, as we like to do here, Nick, looking for some weirdo strikes, some weirdo trades We got the 88 calls trading small, really small out here in October. Hardly worth mentioning, though the strike is kind of interesting. We got some 50 puts doing a decent amount of size out here in March 2009, almost 2000, about 1750 going up out there. So maybe some beers coming in toward 2019, I should say, for the downside here in crude. But it seems like upside is where the action is. Mr. Nick, what caught your eye this week out here in all things WTI, sir?
Well, since it's usually my turn to focus on the volatility, that's what we'll take a look at today. Like you said, vol came in, and it came in, and if it came in a fair amount, but not a like you mentioned. We expect as you move back into a range that the volatility is gonna get taken out of the market, and I think what I was most surprised about is that we moved back up, right? I know when the EIA number came out, we moved right back up into this past the 60 handle. So that was sort of, I think, especially given the wording of it, or at least the message that came across that I saw. So we went right back up there, and then when you sit around, when you go back into a range and you sit around, volatility is going to come out. And you mentioned it before, with if you can't seem to continue to break down, or you can't seem to continue to break through, you're not going to see much. You're not going to see much happen from a vol standpoint. And even though we were up 4% this week, and you and I like to talk about like 2 to 3% moves on top of each other, that is probably more so that will affect the volatility levels when it's 2 to 3% that hits a level and then goes through that level. But when you get in that kind of movement back into a range, I think just generally speaking, you probably say that about most markets, that you're going to see a little bit of a dip in the volatility. Looking at the 14-day and the 26-day and the 60-day contracts, we see the puts got hit pretty good from a percent rich to the at the money, came in almost, got cut in half really in terms of percentage rich, and then the calls got bid up quite a bit from them being below the money. So, kind of a similar shift in the vol curve that we saw in the indexes. Obviously, the indexes from a magnitude of percent rich cheap to the at the money is much greater, but we're seeing a similar tilt of the curve here back towards a little bit more. A little bit flatter between the 25. Well, 25 delta put is still rich, and the 25 delta call still cheap, but much less of a slope than we were seeing over the last week. And again, like you say, like we always say, not much. When you don't get outside of a range, you're not going to see much happen in these numbers. But this looks like a little bit more normal, or what we're used to from a quick skew standpoint. But again, you could go take a look at that on the report itself, and you'll see how those numbers have changed week over week. And the numbers you're going to see out on the report right now, those don't reflect. These are. We don't do curve fits during the day on this account, but we'll do a curve fit at the end of the day. So this is what you're seeing change in skew through last night's settle. So tomorrow morning, when you come look at this, you might see even a greater change in skew if they took a little bit more out of the puts and bid the calls up a little bit more as well. So that's I think what I noticed the most there. You mentioned. You mentioned some of the activity in the strikes on the upside, but again, I like to pay attention to the skew, and just from a regular skew, got a lot of green in the regular call minus put, and we got a narrowing of the channel again in the quick skew number itself. So that one I like to talk about the most because it gives me an idea what the curve does as well as what the overall numbers are doing. So that's what I got so far for you here.
Speaking of what we like to talk about, I think we got to hit on the shiny stuff this week, Mr. Nick, in particular gold. A lot of people were speculating last week that it might have been Mnuchin's comments on the dollar that perhaps sparked a lot of this maelstrom and madness. And, of course, when you see an action in the dollar, you're going to see commensurate action in gold. Didn't have a chance to really get to the shiny stuff last week. There was just too much on the tape for us to digest, but now we got a little bit more time to look back on all things gold. It has been interesting, as you might expect. Gold having a decent week this week, in quotes, up about 35 handles are at about 2.7% or so, right around the 13 half level out there this week. So gold bugs liking themselves a little bit of this week's net action, even though I'm sure they probably would like to see it much higher. So gold has been a much talked about asset class this week. Of course, moving to the upside, this just given coming off the, shall we say, heady vol levels of last week, probably going to see vol come in a little bit, and that's kind of what we saw here with vol coming off pretty much across the board, more aggressively towards the front portion of the curve that obviously gets a little backward in this time of these times of madness, then tends to settle out a little bit as you go farther out the term structure. Vol a little bit more of a mixed bag, again, as you would expect. In terms of where we're seeing the action lighting things up this week, it was out here in March where the action pretty much was. So people keeping things close to the vest, close to expiration out here. Not even waiting for the weeklies, Nick. They're going straight into the March contract, which is effectively a weekly, kind of like the front week contract in and of itself. And what were they trading? Well, the lion's share of the action, as you might expect, we settled out at 13.5. It was the March 13.5 calls, doing about 12,000 contracts. By the way, total OI here for the week out here in gold, up about 5%. It's about an average week. We see usually 3.5 to 5% increases per week out here. And about a little more than a third, about 37% of the volume going up in this front March contract here this week. Like we said, 12,000 going up in these 13 halves. The lion's share actually going up on Wednesday, about 7,000 of that. And net slightly closing on the week, about 1,600 net closing. So a lot of back and forth trading, churning, but the net slightly closing here on these 13 halves. Maybe some people had some positions. We break through the strike or get close to it. They decided to take them off the table. Followed hotly on its heels, number 2, we've got the 1,300 puts. People like their even numbers in gold, and that's holding up again this week. About 8,000 and change going up this week. The lion's share, about 3,500. Going up on Monday, the rest kind of scattered throughout the week. About net 1,700 closing, actually, on the 1,300 puts again this week. So we got some net closing action on the 13.5 calls and the 1,300 puts this week in March. Maybe people taking some funky strangles off the table here. Probably not, but it's always fun to speculate on stuff like that. Moving down to next on our 3 on our list, we got the 1360, so slightly out of the money calls. Again in March, this is where the lion's share of our action was this week. About 2,000 and change going up on Tuesday. That's our big leader, and almost 2,000, about 1,800 going up on Wednesday. The rest scattered throughout the week, about a little less than 1,000, about 800 or so, 7 some odd closing on net on the week on the 1360s. Let's move out of March really quick, though, and see if any other strikes. Nick, I don't see any of our funky, crazy gold verticals. We'll have to check in on our friend and see how he's doing. Spoiler alert, even with this week's upside move, not going to be enough to make a dent in his trade. What's it, like a 3 delta? Let's see here. Let's look. We got the 10 half puts getting pretty active out here in June of 2019, so next year. 10 half puts trade in a whopping 1,000 on Tuesday. All of that opening. So someone coming in and opening for size on the 10 half strike in June of 2019. So all you gold bugs may not like to hear that one, and probably, I'm guessing, probably not blasting those out. Maybe, you never know. We'll have to dig into the book to see exactly what went up there. Would be an odd time to be blasting out those puts, but he did it earlier in the week, so maybe taking advantage of some lower levels to get in the underlying to get the levels that he wants. Also seeing the 1170 puts this year in Dees going up about 3,700 times. Pretty much all of that on Thursday, 3,500 and change going up on Thursday. Pretty much all of that this week opening as well. So net opening on the 1170 puts out here in Dees this week as well. Aside from that, the extreme upside, Mr. Nick, I think we got like 1,800 calls doing about 2,000 and change in August of this year. Those going up a split, 1,000 to 50 on Tuesday and about 1,000 more on Wednesday, both of those openings. So people opening on some of the extremities out here in gold this week, but for the most part, pretty straightforward, pretty much front month, pretty much around the at the money was where the action was this week in gold. Mr. Nick, any other thoughts here on gold skew, gold vol, or any other action catching your eye out here in the shiny stuff this week?
Well, if we look at the March contract, it's got about 6 days left as of right now, and we're down $5 pretty much from what I'm seeing, or at least on the delayed price, we're down about $5. It's a little bit behind, but this thing had a $17 range today. So you definitely got your money's worth on any short dated stuff that you owned. So, if you were long to straddle and you rallied up and you sold your futures and you came right back down, went through strike, and you were able to even if you got out of your futures right at strike again, or you let it go through to 1346, which I think was the low for the day. There's that. I think that's the thing that I'm noticing here too, is I never thought, people complaining about volatility and not high enough, then it gets high and they get beat up, but we talked about all the time, when you get good movement within a range, there's lots of opportunity whether volatility is high or low. So it's a pretty good range. I mean, the range over the rent this week, the rent is about $9 in that March contract today, and the range was basically twice that, right? So you needed a $9 move to kind of capture that, and you got twice that today. So it's a pretty good market if there's liquidity enough for you to get in and out of those strikes, and obviously in the front contract in gold there's going to be plenty, and then if you start to trade those futures when you can, and again, not everybody's necessarily doing that to scalp, but in a range bound, and I could say I would venture to say that gold is kind of rangy. It might be a little bit of a wide range, but it's rangy over the last couple of weeks, and a little bit of an upside bias, but you have that opportunity to get on some positions and make those trades, and the flip side of that is, long gamma, you can scalp the futures. Short gamma, even in a range, you can make money too, because if you pick your strikes the right way, you're basically saying, I don't think we're going to move outside of here, so you can put, sell a call, sell a put, and not do anything. So the scalpers can scalp, and the guys that don't want to scalp, or the gals that don't want to scalp, they can just sit there and let the negative gamma go against them, but feel comfortable that they're going to trade within that range. So that's really one of the bigger takeaways that I get from here. The other thing is, we didn't see much change in terms of the way the curve was shaped. So the puts are still a little bit cheap, and the calls are still a little bit rich, but nothing tremendously out of the ordinary. If we look at the April contract, which is close to the 30-day contract, it's a little, that skews a little wider than it's been. So it also looks like, again, we talk about when you start flipping back and forth between around a given price within a range, you have some opportunity for that skew to flip back and forth, especially if there's any kind of fear or excitement about it continuing to go lower or possibility of going higher. So feels to me like there's some trade there, I'm gonna I put on a hedged position right now in the simulator, so I'll pay attention and watch and see what happens there.
Speaking of seeing what happens, I don't think we could wrap up our rundown of the week, Nick. It's been a tumultuous week across asset classes. I saw an interesting chart coming out of Bloomberg this week saying that, I think it was on Wednesday, obviously it's all frame of reference when you're talking actual historical vol, but the 10-day vol on the S&P had actually eclipsed the 10-day vol in Bitcoin, which was right around 501%. That's, of course, the peak they've ever seen in terms of Bitcoin. It's 501% back, I think, a few months ago. And we saw S&P beating that this week. 10-day vol, I think it was about 520-odd%, 21%, something along those lines. So that was interesting in and of itself, seeing S&P 10-day vol rivaling anything Bitcoin. If you've seen, the week that has been out there in all things Bitcoin, it has been an active one. We saw it taking a nice drubbing out there. The futures over there on CME, I believe, dipping south of 6,000 at one point earlier this week. And then all of a sudden getting the rally ho mode. In fact, a lot of talk of a big buyer out there this week, someone adding to their, but I love that we're getting so specific now. Nice thing about the cryptos is that they can actually analyze and point to which account and which wallet has what. So they're actually starting to identify people who are doing this. And apparently someone added, about 40,000 coins to their holdings between the February 9th and 12th. So going up from about 55,000 to about 96,000. That, of course, helping to drive the contracts back up. seeing some decent paper on the CME contract this week here, with the Feb contract doing about 1,000, about 1,300 total if you factor in the March as well. Remember, that's 5x. It's a 5 times contract. So that's about 5,000, 6,500 when you add in the 5x there. So that's pretty decent paper. People are loving themselves some Bitcoin this week. And Nick, does that warm your cockles that the old Bitcoin back above 10,000? It's got to make your Ripple look a little bit better, huh?
Yeah, I think if you look at what's following that, Bitcoin Cash is actually up much higher percent than the Bitcoin is. And then Litecoin had a really good run this week as well. And the Ripple too, it traded down below 60 briefly 9 or 10 days ago. Now it's back around 110. So yeah, I mean, like I'm not so invested where it's making a difference, but it is good when when any coins that you might be interested in are moving in the direction that you want. So, but I think you're going to start to see some of these subordinate, maybe that's the wrong word, coins get a little bit more attention because they're starting to talk about this different kind of technology, which lets some of the processing time go down because it's running on top of the blockchain in order to verify these transactions. I think one term is they're calling it the Lightning. It's a Lightning is the technology or the name of the technology that they're talking about. But you saw the one thing I've noticed is that with the Bitcoin rally going back up over 10,000, some of the other coins that were hot when it was really hot, they're not moving in the same fashion as sort of the top coins like Bitcoin Cash, Litecoin, the Ripple, and then maybe even like Dash and Monero and stuff like that. So it's fun to watch. I'm definitely learning as I'm paying attention, reading a lot more. Like I mentioned, I think. I mentioned that the All Market Summit that Yahoo ran was really, really good. I recommend that anybody that is interested in this stuff should go over to Yahoo and search for All Market Summit and watch those videos because the speakers were just super intelligent, really well informed, and it definitely speaks volumes to the fact that this is not going to go away anytime soon. There are companies and people investing lots and lots of time and money in this. And I think I'll say it again, the biggest takeaway is that them basically refuting anybody who says, I like the blockchain, but I don't like the currency on top of it. You need the tokens in order for the blockchain process to work. So that's kind of where it comes from. This is going to be around. There's going to be some currencies that win and some that lose, but you need those things in order for the blockchain to work. And I think, for me, it's just another thing to pay attention to and interesting and, nerve-wracking and exciting all at the same time. So you can't say too much more about a market. That's kind of what you want it to do.
Speaking of paying attention, though, you guys are starting to crank out some implied vols and things for Bitcoin. Are you not over there at QuickStrike?
We are. We have some tools that are going to become available. Once they are, we can talk a little bit more about them. But I can give you an idea of what we think things are from a volatility standpoint right now. So we're calculating. The way we're trying to do it is we're looking at sort of short-term windows, like 15-minute bar windows, and then we're also looking at 16-minute bar windows and trying to see. There's going to be a short-term volatility, like you talked about, right? There's going where the activity is happening and you get a lot of changes per minute, and then there's going to be the overall long-term trend of volatility. So interestingly enough, the long-term trend over, let's say, if we look at, I got a 3-month window up here by default. So the long-term kind of the annualized volatility for the regular day-over-day changes, ranging anywhere between like 130% to 155 or 60%. Okay, so and with a peak out at maybe like 175%. So when you're talking about that high of a volatility, that's kind of steady, right? When you look at the line, it's a pretty steady looking line. And then and the reason we did the minute bars and the different versions of the minute bars is to try to capture what sort of the short-term sentiment was on this stuff as well. So the 15 and 60 minute bar volatilities, and we take kind of a year's worth of 15 and 60 minute bars. So that number of changes, and they track themselves pretty closely, but you do see a change. You do see higher volatility sometimes in the short dated one, but sometimes you see the 60 eclipse the 15 minute. So what's the uptake of that? Long term volatility, annualized volatility on the underlying itself, not that wide of a range. Short term, there are definitely swings, but what it probably tells me is that if you can stomach it, you could probably get short when the stuff goes crazy. If there were options out there to do this, you could probably get short and probably do okay here. And also, getting the obvious thing is if you're long and you're long some of the right strikes, you have the ability to probably scalp this as well. So it'll be fun, interesting, exciting to see if everybody's saying they're not going to do options on this stuff, but we've seen enough times where people say we're not going to do something. The next thing you know, they're doing something, right? So it'll be interesting to see which one of the first regulated exchanges come out with some way to trade options.
We'll have to get Tim.
On the
I'll have to get Tim
itself.
McCourt from the CME on here and put his feet to the fire a little bit about some timing for options. I know I did talk to the CBOE and they're doing a lot of technological overhauls. I don't think they'll be ready to go till at least late Q2. So that gives CME an opening to get in there if they can get their ducks in a row first, and that gives them an opportunity to be first out of the gate with options. And we all know a lot of people are, well, I'm certainly waiting for that moment. I'm not touching the underlying with a 10-foot pole, but when the options are coming out, that's when I will get my time in the sun. Speaking of time in the sun, it's your time in the sun here on the old show, because it is time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback. Your turn to take the reins. Got all sorts of many and varied questions, Nick. Let's see. Let's go in order here. Let's start with Scott Sommer. He's got a very specific question, Mr. Nick. Maybe he's an ag guy. I don't know. He says, the question I would have is, how is the call skew between the July 450 puts and the 550 calls in July wheat? And how far does call skew get when the markets are in big caps, full weather mode? So actually, I was looking here, and when this came in just now, I was pulling up the quick strike. You can do this yourselves, listeners. Head on over to the ags and select the wheat, and you'll see for yourself. Scroll on down to July. The wheat closing right now right around 460 for the front month contract of July. A little bit farther out there, right around 490. I'm looking at the quick skew here as well, Nick, but he's asking a weird thing. He's asking the 450 puts and the 550 calls. We know the quick skew does the 25 delta puts and the 25 delta calls. I don't know off the top of my head, I'll have to dig in to see exactly where that puts us in the July contract, but I'm guessing it's not on the 450 and 550 strikes, just off the top of my head here. But I'm looking here at the quick skew, and it is interesting. By the way, listeners, you guys can do this right now if you're listening live. CMEgroup.com/TWIFO. Click on the ags, click on the wheat, and click on July, and you can kind of go off to the races. Take advantage of the fact that sometime Nick forgets to turn it off. So you might get some extra time clicking on the buttons here, which is always a good thing. I know, Nick, we joke about this here, where you and I have joked before about maybe we should factor in more ags here. Didn't have a lot of time this week, but our friend Scott's got a very specific question. What do you have to say for our friend Scott here, Nick, who wants to know very specifically about the July 4-half, 5-half skew in wheat?
Well, ironically, and I will push this out right now, in July.
Don't tell me you were just looking at July wheat on your own. You just happened to be looking at it.
No, but I'm looking at it as he asked the question. And the 450 strike is 25 delta put, and the 550 strike is the 25 delta call. So there you go.
Go figure.
So,
look at him.
So they happen to be right on the money. So if we do that, we can take a look at the July and see. I mean, we could look at a little bit. It's a little bit of a misnomer because it's you can't be. It might have moved around, right? So you can't necessarily rely on the fact of where it is right now, that's where it was before. But not much. If I'm looking at it now, the 25 delta in the July and the 25 delta put and the 25 delta call have not changed much in terms of their relationship to each other. So you got the put, the call is about 10% rich to the at the money, and the put's been around 10% cheap to the at the money. So but this vol it's not like it's 10%. So that's about 2.5% rich and 2.5% cheap when we're talking about it's a 23 vol and like a 23.5 vol to like a 21 and change vol, and then a 23.5 vol to like a 26 and change vol. So that's the skew. I mean, the quick skew. They're about 2.5 each away from money, and it's tilted towards the put being cheap and the calls being rich. Now, with that, this is a 125-day option. So I think, it's hard to talk, like you said, it's hard to talk about specific strikes because that is a snapshot of where things are at this point in time. Now, if you're going to do a trade in relation to the quick skew numbers, like you look and go, oh, hey, the 125-day quick skew is this, and I'm going to put this trade on. Now, obviously, if the market moves like you expect it or you want it because something is rich or cheap, those aren't going to be 25 delta put and calls anymore. But the whole idea is you're putting them on at a time when it's either favorable to do one side or the other, right? So, so looking at it now, the July hasn't changed that much over the last 3 months, but that doesn't mean it's not going to change. That channel looks pretty regular, and I think the only way to really answer that question is to say, well, what does the constant maturity quick skew look like over time for an expiration that's close to that? So I have a 90 and 180-day options out here, so we'll check the 90. So that's closer, and looking at that over a period of time, and I could look at that for the last couple of years. Your average 25 delta call is about 10%, 10 to 11% rich over the last, couple of years, and the put on average over that period of time is about 8% cheap. So puts are a little cheap in comparison over that period of time. And now what I'm going to do is I will add the 180s, and we can try to conject something in between. And let me turn that. We got the 25 delta on. So when we look at it from the longer term, the 180-day, we have the 180-day call over the last 2 years is about 10 to 11% rich, and the put's about 8%. So, hey, Scott, I'm basically telling you it doesn't look like it's changed all that on average. Now, there's been times where it's been higher and lower, but on average over the period of that time, it reverts back to that 10% rich in the call and 8% cheap on the put.
I'm impressed that he had the right strikes for the risky boys. He must clearly be trading some July wheat options. So there you go, Scott. Ask and you shall receive. You guys all have very specific questions. We take care of you here on TWIFO. Let's see. Next up, we got Engel wants to know what's up. What's up with he's writing S&P. S&P, he spelled it out. Put vol coming in despite continued downside in the market. Well, this is a lot of factors at play here, Engel. Obviously, in the immediate crash, vol explodes. Everyone's particularly on the put wing. Everyone's scrambling to get hedges, right? So that supply and demand factors is going to drive up the implied volatility across the entire put wing. By put wing, we mean, of course, the strikes below the at the money strike. So markets crashing. People are scrambling to get short deltas. People are scrambling to hedge their portfolios. Whatever the case may be, they're scrambling to buy that stuff. So that's why that stuff gets all jacked up, to use a technical term. And then, of course, the S&P keeps moving. We see the VIX or volatility getting pretty high out there. I think we got up to well north of a 40 implied vol in the S&P last week, which, of course, when you're looking at that and what that translates back into, that's not just a number in a vacuum. That translates to a substantial move in the S&P on a daily basis in order to really sustain that. You're talking north of 2% a day that you really need to sustain that. For a while there, we did have that. We did have big moves in the S&P, couple percent a day, in which case we were sustaining those high volatility levels. Once we started to not really deliver that, sustained 2+%, and again, everyone has this bias to the downside when they're talking volatility, but volatility is regardless of direction. So it could be upside, it could be downside. You just need to have a net 2% move there, or whatever the price is according to whatever level of volatility it is, and then you can sustain those levels. But when we don't have that, and it's kind of a foregone conclusion that eventually markets should settle down, right? We're not going to have as much vacillation intraday, which of course translates to volatility. You're going to see those implied vol levels start to come in, particularly on the put wing. Also, when the panic subsides in terms of people really needing that downside, you're going to see the puts start coming in as well. So it's a combination of a bunch of factors, supply and demand, as well as, of course, just the basic math that is inescapable when it comes to volatility. What is going on with the actual volatility in the marketplace? That's going to translate into some level of volatility that you then apply into the options markets. So that relationship is kind of inescapable. On some of those crazy days when realized spikes maybe even over-implied, that's very weird. Doesn't happen very often. Then you see really crazy stuff afoot. But in general, it's pretty straightforward. If you saw a continued sell-off, continued protracted move to the downside, then of course you'd see those puts have a lot of juice and probably maintain it for some time. When we saw what we sold off, then we kind of rallied, then we sold off a little bit again, and then it kind of started to tamp down from there. Then you start to see those puts kind of come in, which is not too surprising, I don't think, all things considered. All right, we got time for one more here, Mr. Nick, then we'll wrap it up. This comes from Chill Bill. Interesting question. I hadn't thought about it until I saw this question. But, it's bound to come up for people given the headlines this week, of course, with those products. The inverse S&P volatility products kind of melting down. Chill Bill asking, are there any inverse commodity volatility products? And I thought that was an interesting question. I can't think of any off the top of my head. I'm inclined to say no. I don't think anyone's gone to that lengths. I mean, it's already pretty esoteric to create an inverse S&P volatility product. Look at the number of hoops you have to jump through and everything else. And the S&P is obviously a very, very liquid product. To create something analogous like that on maybe something I don't know, corn or something that's a little bit less volatile or liquid, that would certainly, I think, be probably a bridge too far for most issuers. But I don't know, Nick, is there an esoteric inverse vol product you can think of floating around out there?
Oh, for the ags, I mean,
for any, it could be gold, could be any of the above.
Inverse vol, I don't know, because if you take the inverse of zero on some of the products lately, then you get infinity. So I don't know that you can necessarily get away with anything the way it is right now.
Infinity vol and all these things.
Yeah, it would be, especially the way gold was for a lot of the last couple of years. So I'm going to guess that if there's not, there's probably somebody looking at it, right? Because that all the bad stuff that they think they're going to pull the plug on and that kind of thing, it's all going to come back eventually, just like everything else.
It's going to come back. Well, yeah, that's an interesting question, Chill Bill. I think the short answer is no. Someone might write in with some weird esoteric thing that does one contract a year that may exist out there, but I think for all practical purposes, in terms of real liquid products you can trade, the answer is going to be no. Probably a good thing given what we saw with the lack of broad education on what these products can do in something as readily acceptable and understandable as the S&P. Maybe we should kind of stop there for a while before we start getting into even more esoteric products that are even harder for people to understand, that have different skews than something like the S&P. Well, let's master the S&P first, then maybe we can start building out bridges to other inverse volatility products. Great questions from everybody. We love your comments and questions. Keep them coming. We try to read them all, try to answer as many as we can on the show. Maybe someday we'll do a whole Q&A show, so we do get a lot of questions from you guys. Keep them coming. If we don't answer them live on the air, we'll answer them in some other fashion, so don't worry. You'll hear from us, even if they're somewhat specific, like specific month and call of a skew in a particular product. We'll get into it. We like getting into the weeds here on TWIFO. But before we go, that music means we're already past time. We got to cut it off, but Nick and I are having fun, so we're going to chat for a few more minutes. But that said, Mr. Nick, if people like what they're hearing, maybe they like playing around with TWIFO and all the reports there, and they want to see what else you guys are cooking up, where should they go? What should they do?
Well, same as always, you can always come to the company site, which is Bantix, BANTIX.com, and you'll read about the different product offerings that we have available there. And then for the free stuff, cmegroup.com/TWIO or TWIFO, TWIO or TWIFO. And you could always follow us on Twitter. We'll announce things there. And if you have any specific things in particular right now about any crypto stuff, I would just say reach out with a question on Twitter or DM us or send us an email to support@quickstrike, QUIKSTRIKE.net. We have some things that are going to be made available that are going to allow you to look at historical pricing pretty easily, as well as historical volatility, short-term volatilities, implied vol skew, meaning vol curves associated with those volatilities and the distribution of those crypto prices, as well as pricing sheets associated with those implied vol curves. So I think we're getting into some fun, interesting, neat stuff. So if you want to know how you might be able to get access to that, give us a shout, and we'll be glad to steer you in the right direction.
Give the man a shout. You know how to find him. Bantix.com, BANTIX.com. Click on that Quick Strike link there, and you can get all this good stuff, including all that cool Bitcoin stuff they have coming out. I know a lot of you are hitting us up looking for analytics, looking for something you could use for all your crypto trading. Nick and his team getting in there. I don't see many other people really playing in the implied vol of all things crypto yet. There are a few, but I think given the breadth of products, I think Quick Strike has a leg up on a lot of those other ones out there. And don't forget, head on over cmegroup.com/TRIFO. Check out the reports there, as well as all the other good education they have kicking over there on the CME Group website. And on behalf of Mr. Nick and our friends over there at CME Group, and indeed myself, I thank all of you out there in the listening audience for downloading, streaming, subscribing, sending in such great questions. We love to hear from you guys. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at Bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.